Hi everyone, welcome to the webinar. My name is Sara Waqar and I've been a prop trader and a financial mentor for over 12 years. My favorite markets to trade are currencies, commodities, and stock indices. I'm also regulated from FINRA in USA and an investment manager aligned with UAE ESCA's regulatory standards. I've also been teaching professional trading courses since the past 10 years to retail traders and focus on trading opportunities built on risk management and trading psychology. Amana is a broker with multiple regulations, both local and international. We have over 100,000 traders worldwide and a 15-year track record. And we offer over 5,500 leveraged and non-leveraged instruments over stocks, both regional and international, currencies, commodities, and different asset classes. There's a Q&A section that you see below, and if you have any questions during the webinar, please feel free to drop your questions there. Don't drop them in the chat. Please drop them in the Q&A section. And if you want to reach out to us, you can email us at support@amana.app. You can call us or you can contact us through our website. Today's topic is actually a continuation of the previous topic on price action, and I'm sure most of you did attend that previous webinar as well. But for you that didn't, I will just give you a quick recap. So price action basically is the art of studying prices and looking at raw prices alone as the biggest and the clearest indicator of future price movements. So that also means that you would be relying less on macroeconomic factors or indicators and more on the prices alone to make a thesis about the market and to consider entries, stop losses, and exits. So all financial markets, as you know, are constantly generating price data. It's every second. And these price charts are reflecting the belief of each and every market participant, whether it's an institution, it's a bank, it's the government, it's speculators like us. So all of the decisions and the beliefs of all of these participants actually result in the equilibrium price that you see in different markets. And as we know, we have a lot of economic data and news releases as well. But we assume here that the economic data and the releases all are captured within these price movements. So the price ultimately reflects everything. And trading, looking at price action patterns through candlesticks is what's called price action analysis. And that's the main way that I use in my trading to, get a trading edge and try and predict the markets. Of course, I must add that risk management and psychology are aspects that are much more important than strategy and not, I cannot stress it enough. But in this particular webinar, I'm just going to focus on the strategy part. So I am going to tell you what might be the best way for you as a retail trader, given the fact that your resources and given what you have, given what's available to you. What is the best way for you to have a consistently profitable long-term strategy? And I've had a webinar before on risk management as well, and I'm going to have one again because that is very important and that goes hand in hand with the strategy. And yes, trading discipline is something that is intertwined with the risk management. If you are not disciplined as a trader, you would definitely not be able to execute your risk management cleanly, and that is going to impact your results. So having said that, now we did discuss this pattern, which is one of the most high probability patterns, which is the reversal candle. And what is the characteristic of this reversal candle is you've got this long tail either upwards or downwards. And the long downward tail is indicative of bullish pressure. Now, we did discuss that whenever we are looking at these candles or when we are looking at the price action, they will definitely make more sense on the higher time frames than they will on the lower time frames. So whenever I'm discussing price action, I need you to understand that I'm discussing it on the daily time frame where one candlestick equals 1 day. And if I change the time frame, then I will, let you know. But the default time frame for us right now is the daily time frame. So here, one candle equals the full days. It's showing you the full day's activity or 24 hours of activity. So here, if I'm going to try and locate a hammer or a long tail candle, this is one example. So this is the daily chart for S&P 500, and as you can see there's this candle here with a long downward tail and an upward body which is lying towards the upside. Now why this is an extremely important bullish signal is because during the day prices are pushed down, but that is not where they close. The buyers come in somewhere in the middle of the day or perhaps towards the very end of the day or even perhaps towards the last hour of the session, and they reverse the prices all the way up and they close them up. So this reversal actually shows us the ending sentiment of the New York markets close, which is most important session of the day. And the sentiment of how the New York market closes gives you an important indication about the future movements of prices, the recent movement of prices. So again, we have many such formations, but as you'll proceed, you will understand that the candlestick cannot be interpreted alone in isolation. It has to be coupled with other factors such as the overall trend of the market, which you can read off the daily and the weekly time frames, and the structure of the market, also where that particular signal is located. So by where, I mean, what is the price level? Is it a key support or a resistance level? Is that interesting level? Is it a level where you would expect the price to turn? And so when you take all of these factors into account, along with the price action signal, that becomes a high probability trade. Once you identify such an entry, with all these factors in place, that's a high probability entry. And then you do your risk management to put your stop loss below the price action or above in case of bearish market where you're going to short, and below in case of a bullish market, and then you enter the trade. So today we are going to be looking deeper into price action, and we are going to understand what makes, a certain price action high quality or low quality. So that means we are looking at the formation in detail. So we're not just looking at the tails, but we are looking at how they are formed. For example, if a tail is projecting into the black area of the chart, meaning that on the left side, you do not have any close surrounding price action. Or in other words, the protrusion is very prominent. So as you can see, this protrusion here is very prominent. Or there's another formation in gold, which here, so this is the gold daily. This protrusion is very prominent. Why? Because on the left side here, there is no surrounding price action, which leaves the tail alone. So obviously, at this point in time, we would not have these candles, but we have this part of the chart, right? So this protrusion and recognizing it as something which is really prominent on the chart is, you know, a quality signal as compared to maybe some hammer or rejector, as I call it, which is in a consolidation or in a congestion. So if you pay attention to these things, you would start to get very high probability entries. And of course, such patterns or such formations, they don't come daily. Definitely on the higher time frames, you have to wait for such formations to form. Yes, if you're working on H4, then you're gonna get more signals over there. but I can, reserve that discussion on how we move from the higher time frames to a lower time frame such as H4 to fine tune your entry. But today I will just be, be focusing on the daily time frame. So we were talking about this formation, which is a very important formation, right? So the upper tail is indicative of downward price pressure. So this candle can move prices up and this candle can move prices down. Okay. Now, obviously, this is not a guarantee and your risk management will always be there. It will be there. But how you can make how you can make your entry more stronger is by looking at supporting factors. So, for example, you might have two of such formations adjacent to each other, one after the other, which will make your thesis stronger that buyers are now coming back in the market and they might move the market upwards. And similarly for this. So, okay, somebody has asked me, please show a few more examples of the reversal signs with nothing around. So that is what I call, a protrusion or, a very prominent, I call all the candles with the tails rejectors. That's my own terminology. I don't call them hammers or dodgies or this and that because for me, it is showing very strong price rejection. And so that's I just call it. So let's look at something, let's try and find. So this would be an example of such a, again, a prominent protrusion. Then let's go and see if we can find something in Bitcoin. So these, by the way, these are not very common. So that's why if you spot something like this, you should definitely pay attention to it. Okay. So there is a signal here, but this actually this is a downward rejection, but this particular signal did not work. So this was a signal which should have pushed prices up, but as you can see, prices actually broke down. So this is why I say that these are high probability signals, but they are not, again, guarantees of price moving up and down. Therefore, you should always do your risk management. Yes, this method is going to work with any market. It does not matter because this is essentially looking at price behavior. So it can work with indices. It will work with all highly liquid markets. So the price action would become better the more liquid a market is. And these kind of markets don't have any gaps in them. They are perfect in continuation. So in such cases, price action works very well. Yeah. So this means we should combine price action with further confirmation like support and resistance. You definitely have to do that. So price action is the confirmation for you to enter. It is not everything. It's the last step. The first step is always trying to understand the overall market structure. And that, like I said, is you looking at the peaks and the troughs of a trend, looking at different patterns, which I done a webinar on patterns, but the patterns I'm sure you're aware, like head and shoulder, double tops, double bottoms, those kind of patterns are quite powerful. For example, we observe here that this low was higher than this low. So this indicated bullish pressure. Then we had another low which was higher than the previous low. So this was again bullish. But right now, the market seems to be bearish. And because I don't have a strong bullish confirmation, I would not enter here as, bullish. So what's happened is, so this is Bitcoin. What's happened is it seems to have gained momentum since February. It seems to have gained momentum. But if you're looking for an entry right now, which is a bullish entry, which is in line with the last 2 or 3 months momentum, which is upward in this case, you would also need to identify a strong bullish price action signal, which would make it more, which would add to the probability of the trade. So right now, I don't see anything. I have that the prices are quite bearish in the past 4 or 5 days. So I'm not going to make any move here. Plus, see, if you see this swing point, if the price breaks below this point, then I would definitely be on the sidelines, because in an uptrend usually there are higher is a set of higher highs and higher lows. So if the market is unable to make a higher low than this low, then it should actually cause us to be on the sidelines and wait for more confirmation. Where is this market going? So in such a case, if you're not sure, then just be on the sidelines and observe. Okay. And yes, there are just one market. There's so many different markets to trade. And ideally, you should be in that market which has the best and the clearest structure. Or it can be obviously more than one market, but you don't have to be in, all the markets all the time. Okay. So this is again an example of a false break as well and a protrusion as well. Again, the prominent protrusion that I was talking about. And this is indicative of bearish pressure because the tail is upward. So as you can see in the days to come, again, this is WTI, this is American oil. So in the days to come, the prices have been actually contained within the range of this candle. So this market is more of a range bound market. And we've got these two ranges here. So oil is roughly trading between, so it's roughly trading between 107 on the top and between 80 to 84 is the bottom, is the resistance. So again, for such a market, you should be looking at some bearish price action signal around the upper bound, and you should be looking at some bullish price action signal at the lower bound if you want to enter into the trade. So again, we're trying to identify these signals at the right levels. So again, this is an example of that kind of protrusion that I was talking about. And this is an example, this is silver. So I think we've had some examples, and let's move on. Again, this is the same thing. If the body is smaller and on one side, that's a better indication. So always measure for a bullish rejector, always measure the rejection from the low to the close. The more the distance from the low to the close, the better it is. For a bearish rejector, measure the rejection from the high to the close. And these kind of candles, I've discussed this before, are small candles which with a small range, and they are basically indecision candles. They don't give an important message. Sometimes they do. After a big move, prices could just be coiling or consolidating with such formations. But these kind of candlesticks they are not a call for action usually. They are just, telling you that the market is, the liquidity levels are probably low or the momentum is not that strong. So this is, might be reflecting lower volumes and lower volatility. So a large part of interpreting the candles comes from the understanding the range of the candle. So the bigger the range, the more that candle is able to, start a bigger price move or a swing. So next we come to this pattern, which is also quite a high probability pattern, which is engulfer. So in an engulfer, you have smaller candle, which is usually the opposite color, and followed by a much bigger candle, which engulfs the previous one in its range. So in this case, this is a bullish engulfer because, and this is a 2-day pattern. So this will take 2 days to form, and it's showing you a very immediate shift in market sentiment. And again, you have to pay attention to a few things. The first is the market structure. What is the overall market structure and what's the overall momentum? The second is, what is the price level? Is this an important price level? Is this a price level where I am expecting the price to swing in this direction to become bullish? Does that make sense? And then look at the pattern itself. Look at how big the range is. If the range of this candle is much bigger than the surrounding candles, then that does show you, more higher momentum, or the fact that a powerful move might be just around the corner. So if we go back and if we look and if we try to see this pattern again, So these formations are, more common than the rejector. So what market is? Let me just go to S&P 500. Okay. So this is these two, this is a bullish engulfer here, and then this is again a very clear bullish engulfer. So what's happened is that, prices kind of closed down, but the next day prices moved up by a higher percentage than what they closed down. So they reversed yesterday's losses and actually moved even further up. So the interesting thing to understand is that if you had like a 2-day chart, so over a 2-day chart, if you added these candles, you will actually end up getting a rejector or a candle with a downward wick. So if you take the opening price of the first day and the closing price of the second day, the highest price of the 2 days and the lowest price of the 2 days, and make a 2-day chart, this will be over 2 days. This is going to show you the same thing as a rejector with a downward tail will show you. Prices went down, but then they closed all the way up. But this happened over 2 days instead of one day. So if we look at more, let's try and find. So again, the interesting thing is that sometimes it's not so important to remember the names or to be very finicky about the formation. It's you trying to, get an idea about how to read and understand every candle, every type of price action. So you don't always get perfect formations. For example, look at this. Now, this is not a bullish rejector, but what is this formation showing? It is showing me again the same thing, that prices went down, but then the next day they came up almost 90% of the loss of the previous day were gained the next day. So it is something quite close to that, right? So we don't essentially have to name the pattern, but we have to understand the sentiment behind the pattern. So again, this would be bullish because the second day is going to dictate where the prices might go. And again, regarding your stop losses must be placed below this setup. So the stop loss level in this case would be below the formation here. And this fits nicely because I have it below this consolidation here it's as well, and below this formation as well. So this is again an engulfer, bullish in nature. Now I want to show you a recent bearish engulfer, which has just formed now. So this is S&P, and yeah, this was Friday, okay? So Friday's close is, as you know, the close of the week, and what has it reflected? We know that, there's a crazy rally going on in the indices, right? So just observe one thing. Observe that after how many days did we get this kind of bearish close? So since this day, which is the 30th of March, and today is what? It's the 19th of May. Since the 30th of March, I have not seen such bearish sentiment that was seen on, last Friday. And why I'm saying that, it's very clear. Look at where the prices started and they closed down. Okay, and also if I look at both of these formations, this is a bearish engulfer. Now, what is a bearish engulfer? Is creating bearish pressure. Now, the question here is, okay, if this is a bearish engulfer, should we short? Should we just put a stop loss on top and take a short position? Now, this is something that varies with different traders and with their trading strategies. So for me, I don't do contrarian trades in a very especially strongly trending market. So the major trend is upwards. So I personally would not go short this market. But if somebody else is doing it, then I would not say that is wrong because they have a reason to do that as well. They have some kind of confirmation. But what I would do is, me right now, if I have to enter, the ideal situation would be to let it retrace as much as it does, and then look for a bullish price action signal to enter. Now, the next question would be, okay, if this market retraces, to what extent can it retrace, right? Because a lot of people say you don't know the market tops and the bottoms beforehand. So, how can we enter, right? Now, there are two ways of understanding that. The first is simple support and resistances. So for drawing simple support and resistances, I stick to the daily and the weekly time frame. Sometimes it's easier to draw it on the weekly, but you can also draw it to the daily. I'm zooming this chart out, and I'm going to, and if you look at this, the previous high the market formed, one ideal scenario would be that, the market retraces all the way downwards to around these levels. Sorry. So it goes down to the previous high, or somewhere close to that, right? So it's at 7,300. So it ends up around 7,000. And that is where we start to get interested in entering long. The other possibility could be it does not retrace that much. So it retraces to, maybe 50% of this move, because the momentum is there, the rally is there. That is another possibility. So in that case, what I do is, with very strong trending markets, I use an exponential moving average, which acts as a support, as a dynamic support. But that is again with strongly trending markets, not with every. Since this market has a sharp trend, I could do is I could use the exponential moving average, again, not for all markets, and the 21-day. So I have to change the second settings here to 21. So the average price of the last 21 days with more weight given to the recent prices. That's what the exponential moving average is, right? So the prices, if they touch down and touch the average line, it's in a way saying that the prices have come down to the 21-day average, okay, approximately. And this could be an area where we could start to get interested in observing, some bullish signal or buyers coming back into the market. So this is just an example. You could actually have a formation in between here as well. But then again, we have to look at small things. We have to look at the strength of the formation. Okay, like I was saying, is it a nice looking engulfer with a big range? Okay, is it a long tailed candle? Is it, does any further bullish price action follow that, or, compound it? So these are the things we have to pay attention to. And if we get such an entry, it would definitely be a great trade. Okay, I have a question. What are your concerns about concept of combining the candlesticks with volume? Okay. See, I have talked about this before. I personally, don't use volume because I am trading the most liquid market. So I am looking at indices and looking at commodities like gold and oil, or I'm looking, at FX. So I believe that in these markets, or any market which has a market capitalization of about $1 trillion, volume tends to normalize, because volume then is actually, it is high, it is good in all sessions. So the volume factor actually tends to get normalized in markets which are very liquid. And then it is the price which then becomes the determining factor. But if you're in a market which has a capitalization of less than, 500 billion or even less, and the less the size of the market, the more important the volume comes. For example, if you're trading, a small stock, in that case, where you observe gaps in the price chart, right? So volume is something that is more observable. All of a sudden, you have high volume, or, block trading, and you can actually observe the spike. In that scenario, volume can be helpful. But in these markets where you have, like trillions of in trading, I think that volume cannot actually, the volume indicators by themselves would not actually help you so much. But you can combine them, if you're already using them, you can combine them with the price action. And like I said, looking at the range of the candle itself, looking at the movement is also quite helpful to have an, idea about, what's happening to the volume. So we looked at some engulfers here. I showed bullish engulfers, and I showed you bearish engulfers, and okay, so and which two engulfers. And if I let's go to some other market and see if we can find something similar. So just notice For example, I have this protrusion. This is gold. And I'm 29th of January, and I have this strong protrusion on the black area of the chart before I have this very strong downward move. So this is also known as a false break. And what is a false break? Um, so you believe that the market has broken to new levels, to higher levels, but the market then reverses. It shows reversal, that it was unable to sustain itself on those higher levels and it just moves back. So, sometimes at certain support and resistance levels, which are important, there are traders who are trading breakouts, might think the market has just broken above that level and is going above that level. But what it will do is it will actually, at the end of the day, at the market's close, it would reverse and just come back. So, how do we avoid that? We avoid that by waiting for the market to close, right? So you have to wait for the daily candle to close, and that happens, I think somewhere around midnight here in Dubai. So it's okay to, observe the candle the next day. Okay, as an example, the last candle here is not the final candle. It's going to, it might end up actually being green by the end of the day, right? So what I will do is, this is, for me, this is the candle to, this was this last candle on the daily time frame that I can actually use to make any decision. I will not make a decision based on this because this is not complete. So this is important. So if you want to avoid false breaks, like, then you have to wait for that candle to close. So like, just example, market on this stage broke up, but it did not sustain those levels, right? So it just went all the way down and it closed down. And it kind of formed a level. So this is actually a very, very volatile, and it is very it's something very unprecedented, very abnormal. If you look at the chart and if you see the range and you know why this happened, this was because of the geopolitical tensions reached their height, right? And this has actually created, you can say, a sort of an event area in the chart. And it has now contained all the prices in it. The prices are now moving in a range which is, in a way which is engulfed by this candle. And the third formation, which is a little bit more advanced, it might be, a little bit confusing to understand at first, is the inside bars. So in an inside bar, there is a bigger candle, and then there's another candle which is engulfed in its range. Now, inside bars show consolidation, or they show that the price is collecting or pausing in a certain place, right? And if that happens on key levels in a good trend, it might cause the price to swing in the direction of the trend, right? Concerning the colors of the inside bar can be anything, and that is where it gets confusing. So it does not necessarily have to be green or red or bullish or bearish. It is just a consolidation of sorts, which can move the price in the direction of the main trend. So as an example, again, this is a swing point here. This is WTI, and this candle has these candles contained in it. So again, this is creating a swing point. So again, this candle has this particular one contained in it. Again, it is creating a swing point. So when you start beginning to observe, you can start off with just, one pattern. You can start off with a rejector. You can go back. You can understand and see how it has behaved over time. And then you can move on to other patterns like engulfers or inside bars. So this is another consolidation here in S&P. So this is the mother candle, and it contains all these candles within it. So sometimes what happens in strong trends is that the price, instead of dipping or retracing, will just consolidate. So that is its way of saying that I am giving it a rest, and now after some time I will break. I will just continue with the rally. So because the trend is strong, it doesn't really cause the dip, it would cause the consolidation instead, which is exactly what happened here. And you tend to observe this phenomenon a lot in strong trends. Consolidation is replacing the dip, which happened here. So that can happen to twice, even successively, before you get a bigger dip. I have a question. Which moving average is used to determine whether the price will go up or down? Which one is right to use, SMA or EMA, and which time frame should I use on that as well? So for first of all, regarding the time frames, you should be really clear that you will only get accuracy on the daily time frame or some amount of accuracy on the weekly time frame. When you're using the simple move, even simple or exponential, I like to use the EMA, the exponential moving average, more than the simple moving average, because the difference between them is that the exponential moving average gives more weight to the more recent days, and and less weight to more past data. So the more recent days get more weight. Now, EMAs and SMAs are, helpful when you are just analyzing support and resistances. They will not necessarily cause the trend to, turn, or they cannot create a swing point on their own, because what you have to understand is they are lagging indicators. They are derived from the price itself. So they just reflect, the closing prices of every day as an average, as a smooth out average. So they are lagging indicators, and they themselves will not reflect the sentiment in the way that reading price action with. So it's not as simple as me saying, okay, as if the if the price moves below this moving average, it's going to be bearish, or if it moves above, it's going to be bullish. So no, it's not going to be like that. I have just used this average because I said that I use it if the market is trending strongly, and I would not expect it to retrace to a previous resistance level, because the momentum is so strong. So in that case, it might just dip down to the 21 days average, or even if it's even more strong, you could use the 10 days EMA. But again, 21-day EMA, 3 weeks moving average is, I think it can fit well with the, strong trend like we are seeing in S&P. And it can tell you, it can act as a dynamic support. The prices might reach down to that average and then bounce up from it. So it's not something that I'm using to indicate whether anything about the trend. It's just acting like a dynamic support line. The trend is something that I'm analyzing on my own by looking at, the highs and the lows, or looking at patterns by looking at the higher time frames, by going on the weekly, for example. So here I go on the weekly again. I zoom out and I just understand the trend in this manner. Higher highs and higher lows, and it's very clear. It's not anything complex or any rocket science which will tell me what is the trend, what is happening. I think everybody knows, when anybody can look at the chart and tell. So analyzing the trend is really not hard. Just go on the higher time frames, just zoom in and zoom out, combine the daily with the weekly, and you will know the overall market bias. It's not hard at all, right? And yeah, if there's a market whose trend you don't understand, then I recommend don't go in it, don't trade in it. Well, simple as that. You have plenty of good markets or predictable markets, and why would you want to go in an unpredictable market, right? So again, indicators are not going to create any swing points. They cannot do that. Price action can do that, because indicators themselves rely on prices first. And they're just a mathematical function on price. Yes. So again, another interesting thing that we just have seen, this is the weekly time frame for the S&P. Before we were on the daily. So again, I will show you. This is the daily, where we looked at this bearish engulfer, which could actually cause the prices to retrace. So this is some profit taking happening after a strong rally. This is S&P futures. I was earlier looking at spot S&P. So I'll go back to the spot chart. So as you can see, there's a lot of profit taking. There's no indication of a trend reversal, obviously, because the trend is, upward. But this is again, people taking profits, and market trying to just take out some of the heat from the trend. And I think we know that Nvidia, which is the biggest company in the world now, which makes the AI chips, is going to report its earnings after Wednesday's market close. So there is markets are steady, and I think anticipative of that as well. And I think that is something which will could create interesting price action. So to how do you handle some news information? For example, the world's biggest company is going to announce its earnings on Wednesday. What do you do about that, right? And that is after the markets close. That's after the American market closes on Wednesday. What can you do? The best thing to do is again to observe the price action on Thursday. You don't have to be in a hurry. Whatever will be the earnings and whatever is going to be their impact is going to create Thursday's candle. We have to wait for that to complete, and you might actually have a good setup on Friday, or wait for the week to close, and you might actually have a very strong setup. It could either move the market down or it could move the market up. We don't know. But what we have to do is we have to let the price soak in that information about the earnings, which is very important right now for the indices. And once it is soaked in, the resulting price action would tell us where the market will go in the future. So it is not something that you should act immediately, or just run to the platform and start taking trades, or because nobody actually knows what will be the ending sentiment. So the ending sentiment can be very different if the earnings are higher than expected, or if they are lower than expected, or if they are what was expected. Can There can be any scenario. Even if they are lower than expected, the market might not react in a very bearish manner. Even if they are very, higher than anticipated, the market might still not act in that manner. There might be other offsetting factors. We don't know. But what we do know is the price is reflecting all those factors, hidden or known to us. So let the prices reflect everything. Let the candle end in a certain way, and and then its formation will tell us what the market made out of that information. I have a question. Is leverage a full share, or is it like a CFD's share? So actually, I have given a webinar on leverage and margin. I don't have the time to explain that, but the previous webinars have been uploaded on YouTube, and you can access that webinar. I think it was the second one that I gave. I don't remember the date, but you'll be able to find it on our YouTube channel. And if you see that, you will be able to understand what leverage is. Which investment do you recommend is the best option in terms of buying shares? For instance, a company is listed on the second, shows the company's name. Then next to the option, it is written on leverage. Is leverage the best option to invest in? For most, so if you want to trade without leverage, you can just email us and ask us, and the team will help you if you want the leverage to be removed. And if you don't understand leverage, you don't understand how to handle it, and if you don't understand risk management or stop loss placements, it's better that you start off without leverage. And as you can see, these bolts here, they reflect that this particular instrument has leverage. And if you go down, I cannot, just can't seem to scroll down. Yeah, so if you select the instrument, you're selecting WTI, and if you go down here, you will see that the leverage is 10 to 1, and you can request to change it. You can also request to remove it, and if it's possible, we can do that for you. The thing is that if you are managing your risk correctly, then the leverage actually does not matter, because what you're doing with risk management is you are fixing the risk per trade according to you. So I've given a webinar on risk management as well, and that's uploaded. And if you see it, you will understand that if you manage your risk in that certain way, then leverage becomes unimportant. If I fix my risk per trade and I size my position according to that, then the leverage is not important for me, because what I've done is, for example, I want to fix my risk at $1,000. I have $50,000. I want to fix my risk, so I will then size my position. So my quantity or my position size is going to be my risk, which I fixed for myself, which is $1,000 in that case, divided by the stop loss size. So the stop loss size is given by the market price minus the stop loss price. So as an example, if I were to put a stop loss, just an example, and this is oil again, if I were to put a stop loss here, which is at 98 and the market price is 103, my stop loss size is 103 minus 98. So it's around $5, right? So I put 5 here. So 1000 divided by 5 is the number of barrels I should be trading to restrict my risk to $1,000, which is 200 barrels. So if I am to trade 200 barrels, and my stop loss is hit, if I'm wrong, I will just lose $1,000, which means that in that case, leverage is not important anymore. Yeah, leverage will determine my margin. But then again, and I'm not using that much leverage anyway, because what I'm doing is I'm just restricting my risk. So I don't have to worry about leverage or what leverage will do to me. It will hurt me or this or that. If you do a risk management, it cannot hurt you. So I think we have answered all the questions. So a best option in terms of shares, if you ask me, I actually love the indices, to be honest, because the indices are actually a basket, which is a representative of the entire market's best companies. So yes, you can actually, research and have a few companies, but ideally, in my opinion, these could be the top performing companies or the large cap companies, unless you have some specific interest in any company or you know something about it that others don't, unless that is the case. So the indices are performing extremely well even without leverage. And I did talk about the Japanese index before, that it has actually given around 68% in the last 12 months without leverage even. So even if you have invested in an ETF, which means no leverage, you could have literally gained that much. Even the Nasdaq has given us 33% in the last 12 months. That is a phenomenal return. So the indices are doing really well. And looking at the 20-year average for Nasdaq 100, that's 16%. So 20-year average is 16%, again, a very high figure. And that includes the COVID crisis. It includes the global financial crisis as well. S&P is about 10 to 12% because Nasdaq is more highly weighted on the tech stocks. It's and we have the tech rally, and the tech stocks are more sensitive to changes in the macro environment and prices and investments and capital flows. That's why Nasdaq has actually done much better. So these are the top performing indices. I don't think that anything has been more better or consistent than this market. So I think that if in the long term anyways, the best performing asset class has been stocks, more than commodities and more than even currencies. So it's a very good long-term investment, is a very good wealth building tool. So this is it for today's webinar, and I hope that you've enjoyed and I've added something to your knowledge. And there are a lot more webinars coming up. So on Thursday, we are going to discuss about how to do very precise stop loss placements and how we can use pending orders like limit orders to increase our profits and to fine tune our entries. So thank you so much, and I'll see you on Thursday.